So now let's continue our discussion for Chapter 1, which is Introduction to Accounting and Business. And the next thing that we're going to be talking about is GAAP. And GAAP is a very important thing in accounting. Like we call it GAAP, and it's short for Generally Accepted Accounting Principles. And most accountants, if not all of accountants, they know what GAAP is. So financial information in the United States is based on GAAP. So GAAP is considered to be the rules used in accounting in the United States. In many other countries, they also follow GAAP to implement their own accounting principles. So GAAP is a collection of accounting standards, principles, and assumptions that define how financial information would be reported. There are accounting standards, there are also accounting principles and assumptions. So we'll talk about each one of these. So the accounting standards, these are the rules that determine the accounting for individual business transactions. So these are the I would like to call them like the rules, or I think rules is the best term that should be known for the accounting standards. Then we have the accounting principles and assumptions, and these provide the framework upon which accounting standards are constructed. And we'll talk about that shortly. So within the United States, there is a board called the Financial Accounting Standards Board. You can think of it as an organization. Their primary responsibility is developing accounting standards. So they are the ones who set the rules. So FASB, or Financial Accounting Standards Board, are the board, or is the board that develops all the accounting rules that should be followed. So I really want you to know these abbreviations and at the same time know these different terms, because they're material for questions, and I think it's good for any students who took an accounting course to know these. So FASB, or the Financial Accounting Board, maintains an electronic database called Accounting Standards Codification, which is the code for all the rules that accountants should follow. So these contain all the accounting standards that make up GAAP, or Generally Accepted Accounting Principles. Changes in the FASB codification are made using accounting standards updates. So there's something called accounting updates or accounting standards updates. That's where we change any kind of codification in FASB. Another important organization is the Securities and Exchange Commission. And by the way, that's a federal agency. It's a federal or governmental organization that's responsible for making sure that all companies that are traded publicly or traded in the stock market follow Generally Accepted Accounting Principles. So more formally, it's an agency of the U.S. government. I would like to call it part of the federal government, that has authority over the accounting and financial disclosures for companies whose shares of ownership or stock are traded and sold to the public. So basically, all companies that are traded in the stock market, they have to follow the requirements set by the SEC. Outside the United States, most countries use accounting standards and principles adopted by a different organization or a different board called the International Accounting Standards Board. That's outside of the U.S. But in the U.S., we follow FASB and the standards they set, which are the Generally Accepted Accounting Principles. Now let's talk about the characteristics of financial information. Financial reports must possess two important characteristics. They have to be relevant, and they have to be faithfully represented. So we call it relevance and faithful representation. These are the two important characteristics. So what's meant by relevant? It's related to what we're doing. So information has the potential to impact decision making. Something related to the facts that can help us reach a correct decision. So that's what we mean by relevancy. So faithful representation means it has to be honest. So it means that the information accurately reflects an entity's economic activity or condition. They're not misleading. So one, relevant is related to what we're doing. Faithful representation is honest. It's something that would truly represent the economic activity or condition of the entity. When we talk about relevant and faithful representation, these are enhanced by those elements: comparability, verifiability, timeliness, and understandability. And I think these are very logical. You just need to know them, and once you see them, I think they're very, very logical. What's comparability? This includes consistent reporting that allows users to identify similarities and differences among reported items. So in other words, I can compare the performance of my business to other businesses. I can compare the performance of my business this year to my business last year. So it's something that's consistent. So consistent reporting, this is what we mean by comparability. It makes it comparable. Verifiable or verifiability allows user to agree on the meaning of reported items. Something I can verify, I can go back and verify that this is correct. And that's what auditors do. If things are not verifiable, then it can be easily manipulated. The other thing is timeliness, which has to be timely, something that's recent. Requires distribution of financial reports in time to influence a user decision. If I want to invest, let's say, in Tesla, what would be better for me, the financial reports for this year or their financial reports 10 years ago? The financial reports 10 years ago are not really timely, so they're old, and they're not going to help me in making a decision today. So I have to find financial reports that are very recent, and that's the value of the financial information. And finally, understandability, which means that the financial reports needs to be understandable for those who are willing to understand it. Okay, it's not written in a way that's confusing or people will not be able to understand it. So this requires clear and concise financial reports that facilitate user interpretation and analysis. It's not something that's written in a way that not an average person will understand. Now let's talk about the assumptions. And here we have 4 assumptions that we're going to stress on in this chapter. So financial accounting and GAAP are based upon these following assumptions. The first one is what we call it the monetary unit. The second one, time period, business entity, and finally going concern. So the monetary unit assumption requires that financial reports be expressed in a single money unit or currency. In other words, in accounting, we represent our financial reports in money values. We don't use any other value. We don't care about the weight of our inventory, for example. We don't care about the distance or the area of our warehouse. What we care about to record on the financial statements or the financial reports are money values, money amounts, okay, or the monetary units. And it has to be a single money unit. So in a single report, I have to use a dollar, a US dollar. I cannot use US dollar and pesos, for example. It's either or, okay, and I have to be consistent in the way I present the financial reports. The second assumption is the time period assumption. This allows a company to report its economic activities on a regular basis for a specific period of time. I like to represent this as an artificial period where we try to think of the business as having a starting date and an ending date. So we usually say the company's performance for the year of 2022. So this means from January 1st, 2022 till December 31st, 2022. But the business is still running, so we just want to see the performance during this kind of time period. So that's one of the important assumptions, because otherwise we will not be able to define the period where we can know the performance of the business. So the annual accounting period adopted by a company is called fiscal year. Okay, so in many cases the fiscal year is just the regular year, or what we call it where it starts on January 1st and it ends on December 31st. A natural business year is a fiscal year that ends when business activities have reached the lowest point in an annual operating cycle. So for example, for a company like Apple, their lowest point in their operating cycle is usually September. And this is where their fiscal year would end. And they would start fresh in October. For a company like Walmart, they end their business, the lowest point is right after Christmas. So they have Christmas, the New Year, and then they end their operating cycle on January 31st. So their business cycles or their operating cycle starts from February 1st till January 31st. So that's what we call it, the natural business year. The other assumption that we want to talk about is the business entity assumption. And this limits the economic data in the financial reports to that directly related to the activities of the business, not the owners. Like, I can own a business, and my personal transactions should be totally separate from the business transactions. We should not mix them together. So anything that's related to the business is only recorded in the business books. Anything that's related to my personal use, that's different. So let's say the business own trucks and cars, that's recorded on the company's business, or in the company's, financial report. But if I own a car, even though I own the business and this is used for personal use only, then it should not be part of the records in the business side. So this is what we mean here. It limits the economic data in financial reports to that directly related to the activities of the business. And I want to add a one statement, not the activities of the owners. Activities of the owners are separate. Another important assumption in accounting is the going concern assumption, and this requires that the financial reports be prepared assuming that the entity would continue reporting into the future. In other words, it's not a project. It's not something that has a starting date and an ending date. A business is something that has a starting date, but we assume that's going to continue operating from year to year. And it's not something that has an ending date. So that's an important assumption in accounting, is that going concern, we call it the going concern, that we always assume that the business is going to survive. If we have some doubts about the company's ability to stay in business or running, then in this case, this is something that violates this assumption. So now let's talk about different forms of business entities, and we'll start with a proprietorship. And a proprietorship is a form of business where it's owned only by one person, one individual. And the book here is using like a company, A&B Painting. It's a painting company, and they could just call it A&B. Or you can have any kind of business. It's just if it's owned by one person, that's usually the case for a proprietorship. Sometimes they call it a sole proprietorship. Sole, which is one thing. So 70% of businesses in entities in the United States are in the form of sole proprietorships. Why this is the case? Because it's easy and expensive to organize. Resources are limited to those of the owner. So remember that I would consider that to be an disadvantage, because only the owner, this one owner is the source of resources for that business. And in most cases, small businesses, they operate in this kind of form. It's a one-man show, if you can call it. And in this case, usually the owner is the person who operates the business too. Then we have a partnership, and a partnership is owned by two or more individuals. Okay, 10% of businesses in the United States are in this kind of form. So we have something like Jones and Smith Architects, or two people or more. They are running a business together, and in most cases, both of them, they help each other in order to operate and be successful, and they complement each other. And by the way, there's another form of partnership. It's called the limited liability companies, and that would fall under the umbrella of partnerships. So only 10% compared to 70% where it's only one person. So partnerships, they combine the skills and resources of more than one person. That's a good thing about partnership. Then we have a better business entity format, which is the corporation. And this is organized under state or federal statutes as a separate legal taxable entity. And the good thing about corporation is that management is separate from ownership. So I can be an owner in, let's say, Microsoft, but I don't do anything with operations of the business. And we have like examples for big corporations here, like Alphabet, which is Google, Apple, Ford Motor Company, and list any publicly traded company. All of these are structured as corporations. These are usually the most successful businesses in the United States. So they generate 90% of business revenues in the United States. So even though only 20% of business organizations are structured as corporations, but 90% of the revenue comes from this kind of structure. So that tells you that this kind of structure is very successful. But normally you don't see companies starting as a corporation. They start as a sole proprietor or partnership, and then once they grow, they transform into a corporation. Ownership is divided into shares called stock, and we'll have a separate chapter talking about that. We can obtain large amount of resources by issuing stock, and it's used by large businesses, as I mentioned. One substructure of partnership is something called the limited liability company, and again, it's often used as an alternative to a partnership. Why some people prefer the LLCs or limited liability companies? Because it has some tax and legal liability advantages for the owner. So if anything goes wrong in the business, I'm not going to lose my personal assets. The most I can lose is just the business assets.